Hello and welcome to this continuous coverage on money control on the big union budget, the first budget of Modi 3.0, and it really did not disappoint when it comes to the tech and startup ecosystem. Finance Minister Nirmala Sitharaman really walked the talk when it came to startups. The biggest headline as far as startups is concerned is the fact that she has decided to abolish angel tax. Now, this was something that haunted startups for the last decade, but now finally, without any ambiguity, she has said that angel tax will be abolished. So that's the biggest positive coming out of the union budget. Apart from that, we also saw a lot of thrust on digital public infrastructure, how the government wants to expand this to build more population scale solutions. They've also unveiled a 1,000 crore fund to boost the space economy. Apart from that, they've also done away with the equalization levy, and they have also given a huge thrust to METI, the nodal ministry that's in charge of everything from AI to semiconductors, electronic equipments, and so on. Now, their outlay has also been hiked by 52%. We're going to unpack all this one by one, but let me bring on our first guest on the show. We have Dr. Pawan Goenka, the chairman of the Indian National Space Promotion and Authorization Center. Thank you very much, Dr. Pawan Goenka, for joining us on this special show on money control. The biggest headline for you, I imagine, is the 1,000 crore fund that's been announced to boost the space economy. We have been speaking to space tech startups through the day, and they seem very enthused. How do you think this is going to help?
Well, clearly, this has to be looked in the context of everything else that is being done right now by the government for the space sector. What this does specifically is focus on how do startups raise funds. Now, just a few months ago, the government had issued a revised guideline for FDI in space, which had liberalized the FDI regime and allowed the foreign investors to come in almost 100% in some cases without government approval. And this is in a way phase two of that, where we are saying that government is also going to put its money behind the startups in the space sector and create this fund of 1,000 crores, which would then help to invest in sort of mid-sized startups once they have gone beyond the sort of very initial phase to a phase where VC funding comes in. And what this will do then is enthuse the local investors, the private investors also to come in and invest in these companies where government decides that they are the right companies to invest for. Mind you that this will not be a handout or a giveaway. It is a proper due diligence investment that will be done like any other VC fund would do, except that we are sort of parking 1,000 crores of fund specifically for the space sector.
Right.
Something
We
I don't
are
think has
also
been done
delighted to.
very often by the government. It's one of the very few cases where government has created a fund dedicated to a specific sector.
Right. We're also delighted to welcome Rohit Kapoor, the CEO of Swiggy, on the show. Welcome, Rohit, to this special show on money control. Before I go to Rohit, Dr. Goenka, a follow-up question on this 1,000 crore fund for the space economy. Will InSpace be the nodal body for the fund? Will it be structured like a fund of fund, like what we've seen with SIDBI? How will this happen?
Well, this is kind of early right now. We have just seen the announcement. Over the next couple of weeks, we'll get into more details of how the fund will be deployed. But what I can tell you is that it will be managed professionally by people who know how to do VC funding. And we will obviously pick a professional fund manager or a professional body that will go and deploy this, because they'll have to go through the complete process of valuation, of due diligence, of assessment of the business potential, everything. InSpace will not be directly involved in giving out this investment, but this is an equity investment being done by the fund manager.
Right. Rohit, if I can get your first reaction to the union budget, as we said in the beginning of the show, there was a lot to unpack from startups, beginning with angel tax to the 1,000 crore fund for space economy that Dr. Goenka was talking about. And there was also a big increase in outlay for the Ministry of Electronics and IT. There was a lot of mention about digital public infrastructure. And there was also a reduction of TDS for e-commerce operators. I think it's gone down from 1% to 0.1%. So, from your vantage as the CEO of Swiggy's food marketplace, what in your mind was the most important announcement for you in this budget?
Thank you. One of the things was clearly the angel tax, because this has been a festering issue since 2012. It was brought in to curb some malpractices, which was the intent why it was brought in, but it had a little bit of overreaching implications on dampening the sentiment on angel investing itself. And that is very crucial. I think angel investing really is critical to let 1,000 startups bloom, because that's the riskiest form of capital. I think just that going away puts a lot of startups as well as angel investors at ease. So I think that clearly is a long-standing ask of the startup ecosystem, and that coming through without any ambiguity was a welcome delight. I think the second thing, the TDS is a welcome one, because while it keeps the track of transactions happening on platforms for the formal economy, reducing the rate just gives more working capital back to millions of small enterprises who work with platforms. So I think it's a welcome step. It's a very practical step. But if I have to look at just what I'm quite excited about is, if you look at the economic survey which came out just before the FM speech, it laid out 6 areas of focus, which was private sector investments, employment generation, green energy, support to MSMEs, financial sector reforms, and controlling consumer inflation. Now, as Swiggy, I think we have a direct play in at least 4 out of those 6 themes. So if you think about private sector investment, big proponent of creating an environment where private sector investment can just go multifold from where we are. Because frankly, as a country, we just need more and more of that happening for decades to come, not just the next few years. Employment generation as one of the largest enablers of employment generation in the country today. We feel that this is clearly a focus which is welcome. I think it's very necessary. We have a very large population. We have a demographic dividend which we need to tap into, but it won't happen without adequate focus on job creation. And I think income generation, I will move away from the word job creation to income generation in a variety of different ways. Green energy, which plays straight away into the kind of increase we are seeing on the EV side. And I can go on and on. Support to MSMEs, because ultimately at least the food business, food delivery business is dependent on partnership with lakhs of small restaurants. So thematically, it seems like all the key themes that we feel are super important for the country are in the economic survey, and some of the things came through in the budget speech as well, which was and it's a progress. I think the budget has increasingly become, rather than one very big bang thing which shapes something for next 5 to 10 years, there is a little bit of incrementality into what the budget is throwing up every year, and that's not a bad thing. That's a good thing, because I think consistency and continuity is what the industry looks for, and as long as that keeps coming in the same direction, I think it's very heartening.
Right, interesting points there, Rohit. I'm going to come back to you. As you said, instead of one big bang, announcement, they've been doing it over a period of time. So consistency is something that holds key. But coming back to you, Dr. Pavan Goenka, the economic survey yesterday also acknowledged challenges in India's space sector, such as, the gaps in indigenous technology development and uncertain long-term demand. So what's the government's plan when it comes to tackling some of these challenges?
Well, obviously, everything has to be looked in context. And what the economic survey talked about yesterday was give a very fair picture of where we are in the space sector. It talked about all the technologically sort of advancements that have happened in the last couple of years with all the launches that have happened, and that's very positive. It talked about how the startup ecosystem is now evolving in the space sector with more than 200 startups now and funding of almost $400 million in the last 2.5, 3 years that's coming into this sector. It talked about some of the successes of the startups. And then it went into some of the challenges, which, as you talked about, include some of the technology gaps that we see and the demand that has been talked about as one of the things. Now, if you look at what the government has done in the last 2.5 years after the announcement of space reform, in a sense, we are putting the foundation in place. We have done the space policy, which was a very big thing. We have done the FDI norms, which is again a very big thing. We have released the what we call NGP, the way the policy will be implemented, a very big thing. And we have also released a 10-year decadal vision for the space economy, which is what the FM alluded to when she talked about the 5x growth in the space sector over the next 10 years. Now, what we're doing is in a big way of starting to action many of these things. Now, generating demand is obviously one of the very big things because the demand in the space sector, by and large, barring the space communication or the communication satellites, by and large is with the government departments. And that demand has been met by and large by ISRO up until this point. Now, as we move forward, we need to create the demand from the government to the private sector. We need to create demand in the private sector itself for the private sector. We need to create demand from international business to the private sector in India. Now, that is one of the major tasks that InSpace is undertaking on how do we create this demand for the private sector. For example, we have just finished an assessment of the demand for communication satellites. And we find that we will probably require 3 to 4 times as many satellites as we have today. Now, that is going to create demand both for what might be done by ISRO through NSIL, what might be done by the private sector itself, and what might be done by operators from outside India. We are doing the same thing right now for our Earth observation constellation. In fact, in a couple of days, we'll be launching EOI for private sector to come in and establish a constellation with PPP in the PPP mode. Then we will do the same thing with applications. So all of these things are sort of planned now, and we are beginning to action it. And in some sense, the demand generation is going to be one of the primary thrust and the primary enabler for us to reach that 44 billion target that we have set for ourselves. As far as technology is concerned, the 2-3 examples that were given in the economic survey, which includes the composites, which includes the semiconductor fab and alloys, I think these are the things which we are currently depending on imports. And we are not doing enough of these things in India right now. The work is on, but it is not something that in any way is coming in the way of doing what we need to do. We are able to import these things. Yes, of course, we like to make them locally. And it's not just about technology not being available in India. It's also about the scale. Because given the scale that we have in space, it's not possible to set up sort of highly advanced alloy manufacturing units in India because the investment will not be justified. So I think, again, this is a work in progress. As the space activity increases in India, we'll be able to localize some of these things and close this so-called technology gap that we're talking about. So I think we need to, like I said, work on the supply side, for which we have this 1,000 crore fund that has come in to help. We have many more schemes, some already announced by InSpace, some are in the process of being announced, that will help on the supply side. On the demand side, I just gave you a full description of what we need to do. On the technology side, we have, again, some schemes coming to incentivize the private sector to work on technology development, taking from a TRL3 or TRL4 technology, TRL8 or 9, similar to what the Honorable FM talked about for the 1 lakh crore fund that has been set up overall for private sector to get into R&D and technology. So what I would like to say is that one of the primary reason, or one of the 2 reasons why InSpace was set up, one, of course, is the regulation, the regulatory part of this space. Second is to promote the space sector so that we can identify all the things that need to be done, all the pieces of the puzzle that have to come together to make this space sector becoming a sort of highly economic value addition in addition to whatever else it is doing in terms of technology, in terms of space exploration, in terms of societal value, how to do all of that. So I think this is all fitting in place, and the statement today by Honorable FM is kind of showing the seriousness with which the government is taking the space sector and how willing it is to support this sector.
Great. On that note, thank you very much for joining us, Dr. Pawan Goenka, this evening as part of our special programming. Thank you very much. Rohit, I would request you to stay on. We are also going to have Padmaja Ruparel, of the co-founder of the Indian Angel Network, joining us in a minute. One of the key voices to track today as far as the angel tax is concerned. But Rohit, coming back to you, in the run-up to the budget, there was also expectation that the government would make it easier for new economy startups to list in the country. For instance, there was this expectation that they would allow them to flip to GIFT City, avoid paying a tax, a hefty tax, and maybe then list on BSE, NSE. This is of course for startups who are not domiciled in India, because this has been a big theme this year, where startups domiciled in Singapore, Dubai, US, etc. are flipping back to the country. So in terms of misses, anything that you think should have been done to bring back more startups to India? What else could the budget have done in that aspect?
Look, this is not an area where I have personally delved a lot, because we don't have that complication, right?
Yeah.
But in general, I think overall my sentiment is that if more and more companies which will become sort of the bellwethers of the future, right, list on the Indian bourses, it's great. It's great for the Indian retail investors. It's great for the country. So I don't fully understand and appreciate the challenges in such a transaction and what's the implication on the exchequer, etc. So I won't get into that. But by and large, I think there is I think there is a growing. There was a time, I think, few years back, when a lot of startups wanted to go overseas and list. I think that tide has reversed dramatically. I think with also the way the Indian bourses are performed, and the multiples which are available in the market overall. And I do think that the shape of the Indian equity markets 10-15 years will look very different, and it is very deserving that some of the best companies in India, which are born in the last decade or half and coming to fruition in terms of doing IPO, get a chance to get listed in India. So while this may not happen fully in this budget or at all, but something that I'm sure will be a welcome step whenever it happens.
Right. In fact, I think one IPO, Rohit, that the street is looking forward to is the Swiggy IPO. So we will, look forward to that. I don't know, this month or next month or the month after that. You will have to let us know. But on that note, Rohit, thank you very much for joining us on this special show that we're doing right here at Moneycontrol. Like Rohit listed out, there were a lot of positives to take away for startups and tech on this budget. Thank you very much, Rohit, for joining us.
Thank you so much for having me. Thank you.
On that note, if we can bring in Padmaja Ruparel, the co-founder of the Indian Angel Network. Yes, Padmaja, if you can hear me, thank you very much for joining us on Moneycontrol. It's a big day for the startup ecosystem. One thing that all of you have been pushing on considerably for many, many years is the angel tax. By the looks of it, the angel tax has been abolished. But anything else that you have picked up in the finance document? Is there some clarification that you would need from the government? What happens to existing cases as far as the angel tax is concerned?
First of all, thank you. Thank you for having me on the show. Yes, absolutely. Angel tax, rest in peace. We've been fighting this battle for 12 years. It started way back when there was a planning committee meeting when we were there. That's when it was announced at the budget. And we've since then at IEN, with the leadership of Mr. Srivastav and myself, Saurabh Srivastav and myself, we've been really battling. And today, I think that battle seems to have come to an end. I think what is the benefits of this, and the questions on this are there. The benefits clearly is that the investor pools will open up. People will be much more, whether they are institutions, family offices, HNIs from within India or outside. I think funding in Indian startups should become much more attractive. Number one, companies will be able to now use their cash flows for the growth of their business rather than a Damocles sword that was hanging over their heads due to angel tax. And third, I think this will surely incentivize Indian startups to remain within the country. So through your channel, I do want to take the opportunity of thanking Honorable Finance Minister, Mrs. Nirmala Sitharaman, Minister Piyush Goyal, DPIIT, and everyone involved in making this happen. Really appreciate it. I think we do have some questions, and to be fair to the government, I think these will come through in a short while. Is what happens to startups who have the notices and who have yet to have their cases resolved? Do they sort of all get repealed and they are cleared out? Number two is that there are startups who have cases against them which have been concluded. And in many cases, startups are supposed to have monies refunded from the government. Is that going to come through? If that is, let's accelerate all those decisions and refunds so that money goes back. So yes, I think absolutely this is brilliant news. A dozen years we walked the talk, but the government has actually listened and talked and given us a great gift at the end of the day.
Right, and Padmaja, I think what struck me is a very definitive statement from the finance minister that, this is going to be abolished in all forms, because every few years we would see something on angel tax, but there would be a rider, get the certification, get registered here, then you don't have to pay it, so on and so forth. So I think at least there is no ambiguity today as far as angel tax is concerned. And you also gave us a great headline, angel tax, rest in peace is the right way to put it. But as you said, there are questions and we will go back to the finance ministry seeking clarifications on those. But apart from angel tax, what really stood out for you as far as the union budget is concerned, and what in your mind are the one or two misses, something that you expected but did not come through?
Okay. So I think one other thing that really sort of stood out for me is finally the government has given parity on LTCG, long-term capital gains, for listed and unlisted space, something which we have been asking for a long time. Our contention was that we at unlisted space, especially in the early stage, we take a much higher risk versus listed securities, and we did not want to ask for any carve outs. We just wanted parity with listed space. So I think that has happened. Yes, a little bit at the cost of indexation, but when we do the modeling and all the rest of it, we'll see how it pans out. But I think that's another piece that the government has sort of sorted, and it has made tax calculations for everybody much easier. So I think whether doing business in India is one thing, but paying taxes in India has become slightly simpler. So I think I would also commend the government on that. The second thing which really excited me, that the government has sort of put a Philippe on space with the 1,000 crore fund, the Anveshan, the Anveshan fund that they are allocating for research. I think India, from becoming a product, from a services country to a product country, is now moving to what I would say we are moving into the research space. And this is the evolution of creating IP, creating research that we have seen in some of the other Western countries like US and Israel, where actually wealth and value creation is far higher. So I think this is excellent. It sort of reflects what the Honorable Prime Minister has been focusing on, research, to say beyond papers, right? And talking about indigenization of research and translational research. I think the government is again walking the talk by encouraging that. So all of these two or three things were very interesting. I think the miss for me was truly ESOP, right? The ask that we had was that ESOP should be taxed when ESOP holders sell their shares and not when they exercise their rights. So I think that's a bit of a miss. because the reality is that, especially in the unlisted space, as you would imagine, companies' valuations can go up and then they can also come down. And there are very many such instances. So it's unfair to the ESOP holder that he is paying taxes out of his pocket while when he's exercising the ESOP. I think he should pay taxes when he makes money, which is on the sale of ESOP. That's when he gets hard cash. So I think that was one which was a
Right.
little bit of uh, should I say, a little bit disappointment. But hope lives in the human heart. And I think for us, we've won a few. And I think the government will see the logic here. It's simple logic. And we hope that it will fructify. So I'm very happy because I know exactly what the journey for Angel Tax has been. I know exactly what we've been pushing as IN. We've been investing in IP and research and all of this. So it reflects our journey and our asks through the years over a decade. And it also reflects what the government has been saying. So overall, I'm happy. The second
Right.
piece, I think, which is very interesting is skill upgradation and job creation. I think with AI, Gen AI coming in, skill upgradation is extremely important. The focus on manufacturing, and if you combine it with things like AI with upgradation, it can create a game changer in the manufacturing and industry with manufacturing tech, if I may call it. So,
Right.
all in all, I think I'm going to sleep a happy woman tonight and look forward to another day tomorrow. But yeah.
Right. Sleep happy tonight, but look forward to another day. And knowing you, Padmaja, I'm sure you'll take up the ESOP battle very soon. But on that note, I'd also like to welcome Siddharth Pai of 314 Capital on the show. Siddharth, welcome to this special show on Money Control. You wrote a very powerful column for us earlier today where you said that, with this move, which is abolition of angel tax and rationalization of capital gains in the listed and unlisted space, PM Modi is being hailed as a startup PM of India. You also said this will fuel startup fundraising and ensure that startups lead the charge.
Yeah, very true. That's right, Chandra. I think angel tax startups in India, despite the Startup India scheme, etc., have always been subordinate to their listed counterparts. We've seen this in the fact that the capital gains rate for unlisted was more than twice the rate that applied to listed securities, and the fact that basic stuff like the carry forward of losses when there's been a change in shareholding has not been afforded to startups and private limited companies. The fact that they actually suffered from an angel tax and various kind of regulatory nuisances that were artificially injected into the code. Despite that, India has the third largest startup ecosystem in terms of number of startups, number of unicorns as well. So they're actually a testament to the fact that the Indian entrepreneurial spirit can end up actually tackling any challenge that comes. Now that we actually have the kind of rationalization that the industry has been asking for a long time, I think this will truly end up actually unleashing the animal spirits of the Indian entrepreneur. And we'll end up actually seeing substantial amount of startup activity end up actually picking up, as well as M&A activity that will end up actually starting off very, very soon itself.
Right. Siddharth, Padmaja also mentioned this rationalization of LTCG between listed and unlisted. Again, what implications will that have for investors? And overall, with both these moves, right? On the one hand, you're abolishing angel tax. On the other hand, you're rationalizing taxation in the listed and unlisted space. Will this kind of bring the curtains down on this funding winter, which has been going on for a very long time? Or, are startups in early stages still robust, still healthy?
No, I think the funding winter, the reason why we've had the funding winter for this long is for a couple of reasons. Obviously, angel tax has been one of the prominent reasons. And ever since in 2023, when they extended angel tax to non-residents also, we've actually seen startup funding decline 62% year on year and reach a 6-year low for that matter. Number one. The other reason we ended up actually seeing that kind of uncertainty was the fact that India actually underwent its election. So many investors were on the fence to figure out who's the next government going to be, what would their priorities end up being, etc., on the same. I think the fact that the US is also going towards this election by the latter half of this year, by about November, I think the material uncertainty that prevented investors from investing has actually gone away. Now the changes, even the Indian government has been particularly conscious about this fact, the fact that FDI numbers have actually come down to a large extent. And they've actually boiled it down to the fact that a tax on capital is completely antithetical to capital formation, which is why the removal of angel tax is a fantastic shot in the arm. And even the fact that domestic rupee investors have actively chosen not to end up investing into startups and have instead chosen to put money into mutual fund and listed stocks, tax was one of the primary reasons for that. Because they end up actually enjoying liquidity, a holding period that was half of what existed for unlisted entities, as well as a tax rate that was half of the tax rate for unlisted securities, and everyone ended up going to a listed market. Now that these artificial restrictions and differentials have been removed away, a lot more Indian money will end up actually start coming into startups also, for that matter, even through AIFs or directly into these particular startups as well. The IPO activity will end up actually picking up now that the budget is actually done, and the uncertainty in that has actually gone away. So the latter half of this year, we should end up seeing greater amount of capital formation, and 2025 should end up actually seeing the similar kind of capital as what we've seen around the year 2020, 2021 itself. So we should end up actually reaching those highs extremely quickly as well.
Right. Final couple of questions, Siddharth. While the government has abolished angel tax, there are a couple of devil in the details, right? One is, will they drop ongoing angel tax cases against startups, and no new notices for startups that have raised capital prior to April 1st, 2024. While it's angel tax, rest in peace, there is no clarity on both of these points.
You're right, there isn't. So I think the two biggest questions, the two biggest asks from the industry is, now that they've removed angel tax and they've acknowledged that this is not an appropriate tax to end up placing on startups, all the pending angel tax cases should end up actually getting withdrawn. And for capital raises that have happened before March 31st, 2024, this draconian section should not end up applying. Now, even though we're all celebrating the fact that angel tax is gone prospectively, work is already started in the background now to petition the government on these two particular asks as well. If they do this, then India would truly be rid of angel tax. Otherwise, we will still end up seeing at least at least one generation of entrepreneurs will have to suffer from the last vestiges of this particular tax, as well as in case the government does not end up actually making this amendment retrospective. So work is already started on that. People like IBC and others have already begun work on the same itself.
Right. Siddharth, I also want to pick your brains on the ESOP part, because that again has been a demand for many years, that founders end up shelling a lot of money, and you wanted some rationalization on that, but that hasn't happened this time around.
Numerous other asks from start haven't gone through. ESOPs has been particularly egregious because a number of investors, a number of employees have had to end up actually taking loans to end up actually paying the tax on their ESOPs. And in case, God forbid, the company doesn't do well or the company tanks, for that matter, that becomes a loss that they need to end up actually carrying forward. So we've long been petitioning the government to align this the way that they've done this in the US, they've done this in China, done this in Singapore. Either take the fair market value of the ESOPs as the book value, or end up only taxing it at the point of sale. Even though the government made changes to this, they only applied it to the IMB registered startups, which is less than 3,000 startups out of 1.42 lakh startups that exist in the country itself. We've been asking the government to extend it to all DPIT registered startups, not only the ones who get the income tax benefits for that. But I think it's a work in progress. Angel tax removal is a step forward and shows that the government is receptive to this sort of feedback. And hopefully in the next budget, they end up actually making these alignments and rationalizations as well.
Right. Final question to you, Siddharth. One data point that stood out for me was, the huge increase in outlay for MeitY. I think they've increased the outlay for them by 52%, increased the budget for them. What will this mean in terms of funding for AI, semiconductor and deep tech?
I think even in the interim budget, the government did actually announce a 1 lakh crore corpus to end up for deep technology as well. This would end up actually encompassing semiconductors, EVs and the like itself for that matter, although the details of it still haven't come about. And this increased budget to MeitY as well will end up actually directly aligning with the government's mission to end up deepening the deep tech focus that actually exists within the country itself. I think this is fantastic news. Deep tech companies do actually need long-term patient capital for that matter before they can end up commercializing and going. And it's very, very heartening to see the Indian government end up actually taking this industry feedback and creating these sort of schemes. Obviously, the fine print is actually awaited in terms of the fund of funds, in terms of the interest-free loans that they end up actually putting, as well as the other schemes for that matter. But all the equity investors in the country and the VCs have been particularly bullish on deep tech itself. And this will be a fantastic shot in the arm that the government will give to the entire deep tech industry in the country.
Right. On that note, Siddharth, thank you very much for joining us on this special show this evening on Money Control. Thank you to our other guests as well who've taken us through all the announcements that are pertinent for the startup and tech space in the last 30 minutes. But with that, it's back to Mahalakshmi. Mahalakshmi, what a day it's been in terms of the budget, the market reactions to it. Take it away. What else do you have in store for us this evening?
Well, we have a guest waiting for us, so let's go to the guest straight away. It is S. Naren, CIO of ICICI Prudential Mutual Fund. Thank you so much, Naren, for joining us this evening.
Right, I think they're just trying to connect Naren, Mahalakshmi. But, what have market investors been telling you through the day? Because if you look at the markets, it almost seems like it's digested the impact of whatever was announced in the budget in terms of short-term capital gains tax, long-term capital gains and the STT on F&O. But what are you hearing from fund managers? I'm sure you've also been talking to them on background through the day.
Yes, that's true. So the takeaway obviously is that, we are in a very strong bull market, and a very adverse outcome to the election was taken in its stride. And right from the next day, that is 5th of June onwards, the markets rallied for 7 consecutive weeks, except for the last Friday, where we gave up a lot of the previous week's gains. It's been one-way trajectory, right? So I'm not surprised, and nobody is actually surprised that whatever we lost during the day, 400 points down on the Nifty, we made a complete rebound and closed somewhat flat. So this is very typical of a strong bull market. But be that as it may, it is a negative in the sense that sentimentally it is negative. Especially this short-term capital gains tax going from 15 to 20%, because that's one place, where a lot of discretionary money was coming into equity markets, which is largely your HNI investors, promoters who are selling their stakes in the secondary market. That money getting redeployed into stock markets, into other stocks. So a lot of money was coming into that. They're not like necessarily coming with a 3-5 year view, but because because you have this you party in the stock market, that you will do reasonably well. You go into a fund that gives you steady returns, a hedge fund, etc. So that money now will really think about whether direct money that was going in will definitely have second thoughts about whether it's worth the risk, because already you're sitting on high valuations. Sure. So we have Naren with us now. Naren, thank you so much for your time this evening. Your first reaction: is there a reset in the markets, especially the takeaway in terms of capex spending, the rural spending that has gone up significantly? The complexion of the budget is completely different from what we have seen over the last 5 years. So from a market perspective, is there a reset also?
No, I don't think so. See, basically over the last decade, we have had very responsible macroeconomic behavior by the government. And we have seen a very good way in which they have managed to collect taxes, improve compliance, slowly increase taxes, and find a way to raise resources when the developed world had deteriorating macroeconomics. India had very good macroeconomics. I do not see the kind of giveaways or which we see sometimes in some of the state budgets. I don't see that kind of behavior in central government, which is why fiscal deficit for the next year is much lower, and this is after a good amount of capex. Part of the entire expenditure has been there. So I do not see that, and I think things are what it has been in the last 5 years. That's how we look at it as ICICI Prudential.
Sure. Naren, during the day, whoever we spoke to, there was this feeling that because the capex spending has been kept at the same level as it was projected in the interim budget, it might just be a signal, because a lot of market participants were expecting that from that 17% growth, we might have seen at least a 20% or a 22% growth. It might have been not too much, but then the fact that it's kept absolutely untouched. And there is this rural spending, and of course, as you rightly pointed out, fiscal consolidation. It's obviously that's a great source of confidence to market participants as well. Will the mood really shift away from these government spending related stocks to the rest of the market? Because that's been the real momentum space in the market, if you will, over the last 1 or 2 years.
Yeah, I think it's also a debate on valuations. If you look at some of the capex related players, they have done so well over the last 4 years that there can be rotation. And this has been one of the broadest market rallies that we at ICICI have seen, because the 2007 rally was much narrower. So obviously you can have that rotation out. But we don't think, there is a big change in the way things are. And there was need for rotation. You had a situation where some of the sectors like FMCG had actually underperformed drastically. But you have to look at some of the steps that the government has taken, like a drastic drop in customs duty, which will actually bring down the price of gold. You have a fairly decent drop in capital gains tax on real estate, which is being interpreted in different ways. Not that in any way I'm an expert. So you are actually bringing down the tax on competing asset classes to equities. So, and you have all those kinds of situations also happening at this point of time. So I think it's a very interesting market where there has been one of the broadest stock markets where no one says that only one sector has gone up. Maybe financials have done worse than the rest, but otherwise I would say that it has been a market where every sector has participated. So if you look at some of the dog sectors like FMCG and IT, they've also participated in the last 2 months. And IT had nothing to do with India, but even that has participated in the last 2 months in a fairly decent way for average results.
Correct. But in the budget, did you see strong triggers to spur consumption? Do you think that's likely to happen? Because for a lot of companies and stocks in the consumer durable space, for instance, suppressed demand was clearly an issue. Although stock prices have not corrected so much even there, but it was clearly an issue. Do you see that coming back?
I think, we have to remember we are not in 90s. Some of the sector specific things have to be done out of GST Council today. And if you want to reduce the GST on specific products to focus consumption in some of those areas, it has to happen out of GST Council. I don't think it is a role of the central budget that can do, because today excise duties are moved out and there is hardly any role for custom duty to play in these areas. So we have to look at whether GST Council changes some of these tax rates and focuses on some of the consumption related items. That is how we look at it, actually.
Okay. What are your top 3 picks right now in terms of, sectors or segments? Because as you rightly pointed out, pretty much all sections of the market have participated in this rally, and IT was the only one which was perhaps underperforming in the last 1 year. Even that, after these latest numbers after elections, actually, even that sector has performed fairly well.
So it's a tough job, actually. But, we certainly think there is nothing wrong with banks at this point of time, because if you look at a valuation basis, it is one of the sectors which has done pretty badly over the last 3 to 5 years. And so since we are believers in mean reversion, clearly I would say that it is one of the sectors we clearly look at this point of time. We've been reasonably positive on pharma, and we continue to be positive on pharma, at least for the near term to medium term, because the US generic cycle has also been good, and compared to some of the other defensive stocks, at least they're trading at valuations which are more reasonable. So these are 2 sectors we can think of. for a person who has a bent of not being able to buy high valuation stocks. We did dip into FMCG recently, but then they have gone up like so substantially that whether we want to have that same view sharing at this point of time, I do not know. So these are two sectors I can think of. Very difficult. Clearly, I would say life insurance is a third, which has also done pretty badly over the last 3 to 5 years. Of course, it's a smaller sector than the other two, but it's something that we have been thinking of, given that there have been so many worries in the sector over the last 2 years. So I would say that is the third sector at this point of time.
The securities transaction tax, do you think it will have a significant impact on volumes and therefore on the broking stocks?
No, I don't think so. I think, you look at the way the market has behaved, itself is an indicator, and the numbers were known during market hours. If it was so
It did.
significant, the market reaction would have been different. I don't think it is significant.
Fair enough. Any pockets that you see a lot of exuberance may be ripe for a significant correction?
I mean, clearly, if you look at some of the railway stocks, some of the defense stocks, I think clearly some of them are not priced for average growth. They are priced for extremely high growth. Whether they deliver those extremely high growth, given my value bent of mine, I find it very, very difficult to understand. And I don't think the whole of small caps or mid caps are costly, but there are select small caps and mid caps belonging to different sectors where the implied growth assumptions are out of tune with reality. But even those stocks do not correct. Even if the numbers are not good, they don't correct. And that because there is so much of money available at this point of time in the market, so even they don't correct.
Sure. And one last question, Naren. Do you think, I mean, we've been talking about this large caps being, underpriced compared to, small caps and mid caps. And the argument was that, since FIIs are big investors there, unless FIIs come back to India in a big way, we will not see that pocket correct. Do you see that happening in the absence of foreign investors? Because now a whole bunch of thematic funds that have been launched, they have room to buy a lot of large caps. So do you see that the performance moving to large caps seamlessly?
I don't know. This is one of the tougher questions because at this point of time, at a Nifty level of 24,000 or 24,500, I don't think large caps are dirt cheap or something like that. Clearly, large caps are relatively safer at this point of time compared to mid caps and small caps. And there is support from various ways. And if Fed cuts and there is an emerging market rally, clearly large caps are better positioned for it. So I would clearly say that large caps are safer. But today, the market at this point of time, nothing is cheap actually. And the challenge is that when we speak after the budget, it is not that I think the government did a brilliant job in the budget from every aspect. But the challenge is not the budget. The challenge is that the valuations of the market and the sentiment of the retail investors is stupendous. The challenges come out of that to find there is no pocket where one can say people are scared, so you have to look at it to buy and you will make good money because valuations are going to expand from here. That is the big challenge that we are having. And that's the reason, if I get a chance to come on TV, the only thing that I'm able to say is that bet on asset allocation, because asset allocation is the safest framework when valuations are higher. And so that is what we keep telling people. And clearly, large caps are relatively much safer than mid cap and small cap. But large caps are not dirt cheap, and asset allocation is possibly the best way to go because equity and debt are, once you invest in both, you are always in much better shape. And as the RBI governor pointed out last week, most of the banks are actually saying that they are not getting enough deposits. So I would say that today the combination of investing in both equity and debt, either through hybrid or some other model, is the best way to invest at this point of time. And that is notwithstanding a fantastic budget, which did not unnecessarily do something in the form of deteriorating the fisc or something like that. They did what they should do, and it is unconnected to the budget, I would say.
Fair enough. Thank you so much, Naren, for joining in. We have another guest joining us, Sandeep Tandon from Quant Mutual Fund. Sandeep, good evening. What's your first reaction to the budget, and how did you read into the capital gains tax move?
Frankly speaking, Mahalakshmi, apart from this taxation change, not much has changed in the as compared to the interim budget and what was the final budget which has come out. Okay, I always say that over a period of time we have seen the relevance of budget, as a big episode which used to play out, has lost. Okay, so apart from this taxation change, I don't see any dramatic changes happening. But again, step in right direction. They have tried to balance it out, and the whole market was worried about whether capex will be reduced significantly, and whether, given the political background, whether we will move toward populism sort of thing, and fiscal numbers should not get compromised. I don't think anything like that has happened apart from this taxation changes. And again, this is not very big impact if you ask me. I think market do adjust very quickly, and if you really look at the maturity of the market, it actually adjusted intraday itself. Okay. Now, I'm not saying this entire episode is over and everything is fine. It has its own impact, psychological blow to lot many retail players. So it will take some time. That's the reason I expect maybe market can correct and consolidate, okay, before inching up further. So this can lead to some amount of consolidation happening in the Indian equities. But if you really look at from a longer term perspective, the way I look at, ultimately government is trying to rationalize the taxation structure, and everything is moving towards one number. So let's say all long term is coming to 12 and a half. Maybe this number also moves up over a period of time, and all corporate taxation or individual taxation or any type of taxation from a longer term perspective should be at the similar level. That's a direction if I can read it. But I think it's not very big impact as a lot of people have felt initially, and market has also stabilized. But it's not a small blow that everything can be forgotten. It will take some time to digest particularly on the short term side.
Yeah. So the short term, I mean, how much liquidity, I mean, what is your sense? Because there is a feeling, in fact, during the day we were talking to Saurabh Mukherjee, and he was making this point that, this is a message from the finance minister to even the entrepreneurs and businessmen in this country, that they shouldn't be selling stakes and putting money in equity markets, because this easy money made in equity markets over the last 3 years perhaps is being construed as a reason why private capex is not happening. I don't know how much truth there is to that argument, but what is your take? I mean, is there a lot of money coming from family offices into stock markets that needs to be dissuaded?
So, Mahalakshmi, I think these are all theories which got evolved over a period of time. This will happen. No, I always look at the student of theory of relativity. Absolutes are important, but relatives are more important. Okay, if you can say, if I'm getting a easy opportunity somewhere else, then as a human being, we have a tendency to participate in that. Now, if as an entrepreneur, I have to really struggle in manufacturing, and let's say market, whatever reason, even from a perceived risk perspective or perceived return perspective, if I have to talk about, and people think returns are relatively easy, and people tend to participate. This is what happened in last many years. Multiple family offices have sold out, or the entrepreneur have sold their business, and they have set up their own family office. And today, if you ask me, after 3 or 4 years of bull run, everybody feel happy, it was the right decision. But again, you have to look at from a longer term perspective. But over a period of time, this has become their core business activity. It's not the investment. This is their, so one has to differentiate, like for masses and the guys who's doing services sort of thing, for him it's a saving. But for large family office, ultra HNI, this is the business. So when one big difference one has to, I always try to explain, don't think it is their investment. Though people say, no, they're big ticket investor. No, it is their business. When you start treating the investment and saving, you have answers.
So does that dent that? I mean, will it? Does this change the equation? Because per se, 2.5% long-term capital gains tax doesn't seem like a big move, but the short-term part, how do you read into that? Because 15 to 20% is a significant move.
So, if you really ask me, it's again a psychological thing. For a few months, it will be a psychological thing. People remember the 15 because all these short-term opportunities which were there since the taxation was relatively unrelated to 2015 was obviously on the lower side. Okay, people felt it makes sense to churn your portfolio or trade in portfolio on consistent basis. But as this number changes, I think it has a dent on the market also in terms of volumes. Okay, because ultimately if the volumes on a higher side, the impact cost in the market is as generally comes down, and it is the beneficiary for other players also. It's not only that it is a myth when people say ki some arbitrager is making free money, we should not be allowed. I think it's a myth actually, because somebody who's providing liquidity or somebody is giving you two-way course actually bring down your impact cost. So for me, the market depth is very important. If I remember, if you recollected old UTI days or 92 onwards, when I came to the market, the bid offer spread was 3%, 4%. Okay.
Right.
And then there's a concept of gala on the top of it. Now you look at from 2000 onwards, when derivatives came into picture, the impact cost has come down drastically today in the option futures courtesy because of derivative. And one option is to criticize. Other way looking at the impact cost, because India is one of the lowest impact costs in terms of indices product. So I think overall impact cost has come down significantly. What I have seen in last 24 years post introduction of derivatives, as you know, I was very early in this space, so I track it very closely. So it has some advantage, but obviously the way exchanges has been promoting weekly settlement, every day some expiry is there. Obviously, then you are encouraging. If you I'm very candid to say, if exchange become business houses, okay, so obviously their focus is on profitability, they will launch all these products. I think regulators should look into these things. These all weekly daily settlement process should be stopped. We were happy to do it on the monthly side, and that was the healthy trend. I think some changes will come on that side also, but from a impact perspective, I will definitely expect it has a huge impact on the mid and small cap, particularly on the impact cost perspective.
Fair enough. That I think anyway SEBI is considering, right? So I think the bigger bad news is yet to come as far as derivatives trading and volumes.
Not only is about
concerned.
value, it is the one just monthly exercise, because it's a important, it's not a speculation, it's a hedging mechanism, it's a very important. But when you encourage every day settlement happening, and that lead to good amount of speculation get built, and that's something which need to be avoided.
Correct. What is your favorite hunting ground now, Sandeep? I know that, the last time we saw you were a big buyer in HDFC Bank, which has played out very well. You have large exposure to Reliance. So the shift from mid-small to large caps you already made. In terms of sectors and segments, what is your favorite hunting ground right now?
Lakshmi, we as a house always, with the help of a predictive analytic thesis, we always believe in identifying the inflection points. Okay. And we are generally ahead of the curve. If you notice that right from January, we have been talking about consumption as a theme. In fact, we launched our consumption theme around that time, and we said timing can't be better than this, because we saw early signs of green shoot in the rural economy, which has been affected badly post-pandemic. And that we have seen now. Even look at the current budget also, it's giving you some indirect benefits or increasing the consumption. At least government has also felt that consumption has suffered. The infra aspect has been overemphasized over a period of time, and the consumption has suffered. So disposable income, at least some attempt has been there to increase the disposable income. I could have expected much more if they could have tweaked the more on the taxation side, up to 7 lakhs rupees. There should not be any tax. That could have even increase the disposable income. I think that was very much needed for the middle class, because they have suffered a lot. So with that background, we as a house are very opportunist. We always try to identify sectors. And obviously, when we talk about consumption as a theme, or the FMCG theme which we identified, I think most of the majority of the stocks are large cap sector. So by default, we have moved. When we move towards energy, majority of the energy companies are large cap. So by default, we move towards large cap. Again, when we talked about when we shifted from public sector to private sector banks, and obviously the name which you mentioned, again, a large cap. So it's just a lot of coincidence also, but some amount of risk off environment also. We have been very vocal for last many months that easy phase of bull run is over in India also, and we are in the bull run, decisive bull run, but we are in difficult phase. And last 1 week or 10 days, I have been talking about also that the challenge is not India. The problem is in US market, because good amount of complacency is getting built in US market. The risk appetite cycle is speaking out, and we are seeing some early signs of worry, even the bullion market. And that's the reason I said it going forward, market will be more volatile, and which we have seen it played out quite well in last 1 week. I expect this sort of trend can continue for a while before you see leg up again.
Okay, more on the risk aspect, but before that, one question, which is on consumption stocks. Are you bullish now? And this tax cut or the increase in standard deduction that you've seen, the increasing purchasing power on account of that, where do you see that kind of spending having an impact in terms of stocks? Are there some direct beneficiaries you can clearly identify?
So I think it is very difficult to pinpoint one name, but if I look at the collective picture, what is emerging, and which was the case in the past also, it really endorses that we have to move towards consumption name and FMCG in particular, and that to ruler-centric FMCG stock, if you can identify, because that was the pain point, and there we see some signs of recovery. So we can identify, and one should not look at this budget only or in isolation of rural demand picking up. But I think we look at also on the in terms of under ownership aspect. These are the sectors from 2020 onwards when they peaked out from most admired territory. They actually came down to the neglected phase. It was in a quite neglected phase. People have given up actually in the sector, and that's a time as a house we believe these are the best inflection points. So I think it's a early trends. The cycle has just begun. A lot of people will believe they are expensive, and I think this name has potential, much more legs to move up further. Maybe today it has rallied sharply, so small correction I'm not ruling out. But I think directionally for FMCG name and consumption in general, I think trend is up.
How about these gold jewelry stocks, Sandeep? Are they going to be significant beneficiaries of this cut in customs duty?
First of all, obviously, the smuggling aspect which was going on in the market, because the gap was very large, I think that should come down. So it will actually boost the demand for gold through official channel. Now it comes to stock specific, it's very difficult to pinpoint because we have to look at what was the inventory level. Okay. So everybody is very excited to talk about these names, but if assuming some of these companies have very large inventory and it is not hedged, I think they will suffer first. So there's no question of any gain. But that is very important to understand the inventory level and the hedging policy which they follow. But obviously, when prices comes down, okay, and it will boost the growth. So from a demand perspective, also, I think some amount of positive reaction will be there. And I think market has demonstrated today itself. This is the opportunity. But I will not read too much, and one has to be very stock specific.
Fair enough. You were talking about risk from global markets, Sandeep. Are there any other risks, and what are you watching in terms of triggers for a significant correction in the market?
See, when we track when we talk about that market has been very complacent, and our complacency indicators, whether we talk about the precious metal space or we do talk about even some of the base metal stocks or even US market, some of the developed market also, they were very, very complacent. In fact, these indicator has spiked significantly, which is signs of some amount of caution for me, or the vulnerability factor moves up. That's the way I define it. And something similar is emerging from the currencies market, commodities market, and in general equities market. With that background, we expect that employed walls of the cross asset cross market will spike, and they've already seen early signs of recovery there. And if it spike further, it will increase the volatility in the global asset classes. And generally, people don't like too much volatility in the market and leads to some sort of risk of phase. So I'm saying very openly that is a mild risk of phase is very much clearly visible in the developed market, but is not the case in India. Okay. India and select emerging market, actually risk appetite is rising. So which is a healthy trend. That's the reason I always say India's buy on dip opportunity. One should not look for trading sort of thing out here. So something has changed in India from long-term perspective. And money manager like us who specialize in money flow analytics, where we are able to do very fast sector rotation and stock rotation. That's the best way to manage money. One should not exit the market. A lot of people say, let me exit now, I will time it better. And I have seen this noise in the media from the analysts, best of the money manager have been so negative in last 1.5 years. India is expensive, expensive, but every time it's actually moving up. Okay, I have seen so many people have raised very large amount of cash. So I think our approach has been, we are very clear that something has changed. India perception analytics data is also endorsing the similar thesis, but sector rotation, stock rotation really help us to be ahead in this game, and one should remain invested. That is, it is like one of the lifetime opportunity we have from a longer term perspective.
But what would you see as a signal of a significant correction? Is it flows? Is there any barometers to tell us that a reversal may be in store?
So
If not a
it has
reversal,
to-
a significant correction.
So it has to be linked with the global market. If you see a very, today I'm saying mild risk off phase is already started. But if I get into that saying that this mild risk off phase becomes a very meaningful risk off phase, then Indian market can also correct. But it has to understand, and one has to track it on daily basis, not try to uh, conclude because developed market phenomenon is there. So risk is global, risk is not local. Okay, so that aspect you have to keep back of the mind, and that's the reason even if let's say even correction comes to India or some of the sector or patches will some small lift correction can be there. It can be sharp. I'm not ruling out, but it will be short-lived because Indian macro picture is one of the best in the world on relative basis as well as on the absolute basis. So I think the game has to be played very smartly by managing a right allocation and shifting your stocks on continuous basis.
Thank you so much for joining in, Sandeep.
Yeah, thank you,
We have
Malini.
another guest waiting for us, Bharat Shah from ASK Investment Managers. Bharat bhai, thank you so much for your time this evening.
Yeah, hi Mahalakshmi, how are you?
Very good, thank you. What's your take on the
Can't see
budget?
your face, so it looks like I'm staring in eternity.
Sorry, I didn't get that.
I'm not able to see any face, so I'm staring blankly at the screen in eternity.
Oh, I don't know how to fix that. But
Okay.
as long as you can hear me,
Yes, I can.
what is your takeaway from the budget? Does the capital gains tax really dent sentiment in any way? Do you see it as a negative, or are you delighted about the fiscal consolidation path, which a lot of people are talking about?
Now, clearly, if we look at the budgetary exercise of this government for last few years, a few things emerge very clearly. One is fiscal discipline and rectitude. Second is prioritizing capital expenditure, which is a productive expenditure to build future and to create capital efficiency over mere revenue expenditure, which is for a near term or short term gratification. Third, its efforts have been very strategic in sync with the long term economic priorities, and therefore, any particular budget is linked to that larger tapestry of economic vision for the future and the economic priorities that the government puts upfront. Therefore, budgetary exercises in the past used to be in isolation in itself. We can very clearly see a kind of a logical linkage of each budget from the previous one now, and therefore it is much more strategic in nature. The fourth part, when there are benefits to be given, it is done through, these are done in a very efficient way. And these are not merely socio benefits, but socio-economic benefits. So things like house, things like toilet or things like gas. All of these are important socio-economic benefits and not merely social benefits. Fifthly, any effort to give amelioration or benefit on important spends of the people. I think again the approach is more to build capability and economic assets. Therefore, the solar rooftop yojana, which was put about 4 months back, where it pays for the asset over a period of time through the revenues generated from excess electricity supplied to the grid, apart from paying for the self need. Therefore, these are right and important ways in build to build these benefit structures, where it is economic efficiency created at the same time important economic needs of the people are met with. So I think this budget is a further step up in that direction, where priority on the capital expenditure remains, productivity is emphasized, important economic vision priorities are highlighted, and budgets are logically linked to those priorities. Important major area in this budget has been on employment through variety of the yojanas and schemes which have been announced. Again, are a step towards deepening the capability, whether through training and apprenticeship models, to kind of provide a succor in employment important issue. So I think these are right ways to address important economic priorities, and therefore I'm delighted about many of the provisions and many of the steps which have been taken, and therefore this budget is a logical kind of a step forward of the past budgets in last few years that we've seen. On the capital gains aspect, this is my personal view, and I hope I am not accused of self-interest in that. But I felt that capital gains could have remained the same. Often I've heard about debates about, harmonizing capital gains tax rates for different assets. But equity is clearly a much, much higher up in the ladder in terms of risk asset. And therefore, to harmonize the capital gains tax rate in the same way to some other asset probably is not the ideal comparison between the two asset classes. I think equity stands on three important pillars. One, equity markets are among the greatest allocator of resources in the desired channel. Therefore, both it promotes capital efficiency plus it raises capital for the businesses which deserve to raise. Therefore, it's a greatest allocator in terms of raising resources as well as prioritizing assets in the right direction. Second, given the fact that equity assets, which is the most important value creating asset among the household assets, is still at a meaningfully low percentage in Indian households, even though it has improved in last 2 3 years. Still at 6% of household assets, equity is meaningfully small percentage of the total household assets. This needs to go to 20 and 25 and 30% over a period of time. And to that extent, that asset needs to be prioritized. Third, I would definitely believe that equity asset carries a greater degree of risk, and that risk needs to be countered with a long-term holding of that asset and with a long-term clarity of how to invest into that asset. Given its high risk profile compared to the other asset class, I think equity tax rates need to be in parity with that risk profile at an appropriately lower level. Also, if you see one more parity mutual funds essentially when they buy or sell stocks, neither they pay any short-term gains tax or nor pay any long-term gains tax. But the same asset held by an individual needs to be paying that short-term or long-term tax. Even though mutual funds are pooled vehicles, the underlying pool should be paying the tax for the bought and sold assets, whether short term or long term, but it doesn't. So long as you hold the asset for a longer period than 1 year, you don't pay any tax, even if underlying pool may have gone through a lot of churn. So I think this also is a gap in the taxation structure which needs to be kind of sorted out.
So,
When
how
I
do you
get
see
into
that? In fact, that's a very interesting point that you've raised. Do you think money will now, a lot of high net worth individuals who are probably or family offices going through directly into stock markets now will reorient or channel their funds through funds? In a sense that
no,
asset management companies will be perverse beneficiaries of this move?
uh, may or may not be, but that's simply because that's a fact which has been there for a long period of time, not just today. When the short and long term gains were 10 and 15%, also this reality prevailed. So it has not altered with the increase in the tax rate, really. I'm merely pointing out that there is underlying structural point which is being made, that harmonizing tax rates among different assets, different asset classes. Then in sync with that, I'm saying another asset class held through the mutual fund, the same listed equity pool, the tax treatment is different, and that also should have been harmonized. So that's one point. Second point that I'm making separately is that equity is an allocator, arbiter of capital allocation in the most productive channels.
Right.
That's the most important channel for raising equity capital for the deserving businesses. Also, is a greater risk asset class, and is a percentage of household assets. It is still a meaningfully low percentage. Given all of that, I would have preferred the tax structure, at least for a length of time, should have been kept at what it is today. But that's my personal view. And as I mentioned, I hope I'm not accused of self interest, which is motivating me to say that.
No,
I
that's okay.
hope
You
that
are allowed to say that. You're allowed to say that you're a significant participant in the stock market, and you're allowed to say that, especially on a day like today. Bharat Bhai, what is
I'm
your,
saying
what are
because
your
I
top,
too.
what is your portfolio positioning like right now? Where are you overweight? Where are you underweight?
Lakshmi, on that, nothing significantly is altered with this budget, or that it needs to alter. Where we are positioned, I think where we are positioned is where we see greater long-term growth in the markets lying, or in the economies lying. So the businesses in businesses of energy transition, energy equipment, energy financing are important opportunities, and which will enjoy a growth rate much higher than the GDP growth rate for some length of time. I think businesses which cater to infrastructure building and infrastructure itself, whether ports or whether highways or whether airports or airlines or any of the infrastructure businesses, or the businesses which facilitate building of the infrastructure like capital goods, again remain from a medium to greater medium term, I would say, a much superior growth rate compared to the underlying economic growth rate. I would say specialty manufacturing businesses, and given the rightful thrust on the manufacturing that the government has been emphasizing, really are the businesses where meaningfully superior growth rate would occur than the GDP growth rate. And that again is the third important opportunity. I would say uh, logistics, digitization opportunity in various businesses again are businesses which will have significant opportunity.
When you
The
say
other
digitization, do
activity,
you mean the platform companies? Do you mean the
it
pure
could
plays
be.
like, Paytm, Nykaa? Are those the companies you're
No,
referring
I'm
to?
I'm not necessarily referring to those kind of businesses that you mentioned. I'm talking about digitization as a tool for promoting efficiency of the businesses, capability of the businesses, able to acquire greater business or custom, ability to deal with it in a much more efficient way. It is those aspects which have dramatically changed over last few years, and
Right.
therefore digitization is a major tool for transformational growth and superior quality of the growth, which businesses are using, or where there is a greater application of usage which will promote the growth, is what I'm referring to. Also, businesses revolving around India's important, security or Atmanirbharta needs, again are very important economic priorities, and therefore we can see where the thrust is lying, and those businesses acquire meaningful opportunity. I think pharmaceutical will continue to remain, in my opinion, especially domestic pharmaceutical market, a very meaningfully large opportunity going ahead. Select consumption businesses continue to remain very attractive opportunities. Probably less about typical olden day consumer staples, but more about discretionary consumption, refined consumption, luxury consumption, distinguished consumption. These are opportunities which are much more significant. I think lending businesses of late have not acquired as much traction as the underlying improvement in the strength and the quality of the businesses, apart from the rate of growth. But lending businesses also would remain a very important opportunity for a meaningful period of time ahead. And the valuations also are meaningfully attractive to support that. Also, businesses which are prioritizing, circular economy which is looking at healthy growth along with the growth which is resting on the multidimensional aspects of economic growth, whether from the green energy perspective, from a climate perspective, many other important aspects. I think I'm not necessarily referring to the ESG aspect here. I'm more speaking from the growth which is sustainable, because it is more rounded, more circular in character. So those businesses clearly will thrive, because they are aligned with the priorities of any government in all parts of the world.
Fair enough. That's all we have time for, Bharat Bhai. Today we'll catch up sometime later, and I'd love to have a more elaborate conversation with you. Thank you so much for joining in today. We have another guest, Vikas Khimani, joining us. Vikas, good evening.
Good evening. Good evening. Hi.
Does this budget reset things for the market?
No, I don't think, there is specific to reset kind of thing. I think it's a good budget. A lot of things have been continuation of what this government has been doing over last many years. So I think the focus on employment generation, agriculture, productivity improvement, MSME, skilling. All the things are very good, much needed, focus. And I'm sure government has, thought through a lot, and all these things only goes towards propelling the growth of India in right direction. Of course, I think there are a lot of reforms in some sense has been done on the taxation front. Of course, there's a disappointment on the front of capital gain tax, which I think probably could have been avoided. But it is what it is. But I don't think that's going to be a game-changing event for markets either way. I think it's an incremental, 25-30% extra cost for tax, which we all have to bear. But in general, otherwise, I think government has maintained a good balance of fiscal deficit, uh, finding the resources for capital investments, finding the resources for directing the to required sections and segments of the society. So I think in general, I see it's positive. They have not increased the fiscal deficit target. They've kept it in a very tight manner, which also is good. So I think this government has kind of showed that time and again over past many budgets they have presented that they're very serious about fiscal deficit. They can find resources for right purpose, and that's what has been displayed.
Hi,
Karun.
Vikas. It's Karunya as well joining in the conversation.
Sorry, your voice is not very clear.
Can you hear me now? Is that better?
Yes.
Okay. So, like you said, what's done is done, and you have to now live with this new, revisions in the LTCG as well as STCG, both brackets. But now that several assets listed and unlisted are kind of on a level playing field, there has been upward revisions in some. In case of property, there has been a different kind of revision wherein it again brings it back to 15% for LTCG, 12.5% for LTCG. So talk to us about how the investor behavior now or preferences could now potentially change, given that equities does not stand to be the only or the most attractive proposition for an investor anymore.
I think it's a probably not right to say. I mean, people invest into equities not to save tax. People invest into equities to generate returns. I mean, that's very clear. Of course, additional benefit of tax makes it attractiveness, but that does not change whether it is 10% or 12.5. So, in my opinion, it's not a materially changing cost in minds of any investor. I think first and foremost important thing is that can you make 15, 18, 20% return on equities? After that, on the gains, as and when you realize you pay some tax, which is fine, so I don't think any material change would happen in the sort of investment decision, so to say. Even in the real estate, I think probably the indexation has been done away with, and now flat 12.5% tax would be done, would be levied, which I think could increase the tax incidence on the real estate. But again, you don't buy real estate investments for a few years. You buy real estate investment for a very different purpose. So I think really don't think there's any going to be any change in the investment behavior because of this. These are the all. I mean, this is not the first time taxes have been changed on the capital gains front, and this is not the last time taxes have been
Yeah.
changed. This will keep happening, and I think we should see this in light of a normal continuity.
But you don't think it makes avenues or asset classes like unlisted bonds, debentures, debt mutual funds, etc., relatively more attractive than they were before vis-a-vis equities?
Absolutely. So I mean but the government has to have, or there has to be balance across all asset classes. How do you get credit into the economy if everything gets tilted uh, towards, let's say, only equities? So in fact, you should not have tax arbitrage between two asset classes, and then based on the merits of the risk and reward of that asset class, it should be finding its own in its own purpose and path. So in that sense, it's good that and some amount of money. Please understand, when an economy like India needs to grow, it also needs credit. It also needs sort of both equity as well as debt. And in the recent past, as you know, that banks have been struggling to get deposit growth going. CD ratios have gone up. So I think some part of money, if it goes back to debt, I'm very happy because that will avoid sort of bubble into equities and sort of balance out the debt. But I think these things probably takes its own sort of path. So I'm not put up anything in particular. I don't think equity flows will dry out. In fact, equity flows come only from a very long-term, significant, high-risk adjusted wealth creation, which I think it still continues to remain on a post-tax basis.
Okay, so let's leave the tax tweaks aside and talk about sectors and industries that stand to potentially gain from here on after the host of budget announcements that the finance minister made today. What sectors or themes will be on your radar, Vikas?
I think the investment cycle continues to, anything capex related manufacturing segment. I think a lot of boost has been given. Capex side, I think infrastructure investment side, a lot of boost has been given. So I think that is again continuity more of the same. I wouldn't say that anything changes because of the budget. I think it's just basically more of the same, and which is what markets wanted. So I think India's story continues to remain cross manufacturing, infrastructure, consumption, financials, and services. And each of them, I think, will continue to do well, according to me. Uh, of course, consumption, like one of the things probably you could think is that because the custom duty on gold has been brought down, probably, jewelry segment might find a little bit more sort of traction, but they are all, I think, gets adjusted in, a few quarters. So, and short-lived. So nothing, major changes. If you ask me, this budget has been more of the same. I think probably we'll talk today and tomorrow, and next week we'll forget about it. And life will become as usual. I don't think anything is changing materially.
Because you are a big investor in some of the PSU stocks, you made a very vociferous pitch for PSU banks when we spoke during the last Diwali. Tell me, what is your take on PSUs as a pack right now, and particularly on PSU banks?
I think it continues to remain. If you see same thing, nothing changes. Like I said, PSUs are, I think, being managed very well. If let's say if I were to talk about PSU banks, I think the asset quality, technology, and governance, all three fronts, these banks are doing well. Most PSU banks are inching towards 16 to 18% kind of ROE and reasonably good growth. And as Indian economy grows, I think they will continue to grow. So, I think there's a reasonably still good merit in getting them re-rated further from here. And same thing can happen in other PSUs. Of course, some PSUs, specifically in the defense and other spaces, there has been overstretch on the valuation. So one has to be careful about that. But those PSUs, from a growth perspective, will do well. What has changed is we have not bought PSU only because of divestment or related activity, but more because of the transformation happening in them from a building of those organizations, growing of those organizations perspective, and that continues to remain intact.
We have another guest joining us, A. Balasubramaniam from Birla Mutual Fund. Bala, thank you so much for your time this evening.
Thanks, Mahalakshmi.
This LTCG was on expected lines, or were you surprised? Because everybody was arguing that there is no logic behind this move, but finally it's happened.
Frankly, I was surprised that even I was of the opinion that long-term capital tax they will not touch as far as the equity is concerned. Given the fact that equity market has been, apart from rising, it's also been helping most of the companies to raise equity capital to fund their growth needs. And as a result of that, the corporate balance sheets have now become less dependent on debt and more dependent on equity. And given that being the trend, I did feel that they will not touch the capital tax rates. But of course, there was some kind of feeling that we had, even I personally had, that the F&O market, they will bring in some element of soothing effect, rather than stabilizing effect by introducing security transaction tax, increasing security transaction tax. But having said that, I think 2.5% increase in long-term capital tax, 5% increase in short-term capital tax. I think it can do two things, good things. One, of course, increase in short-term capital tax by 5%. Naturally, the holding period for investors can go beyond 1. To the extent you will probably see the holding period rising in general for the equity market, as well as for on the mutual fund part. Second is the 2.5% increase in capital gain tax. I think if you take the simple math, if somebody holds it for 5 years, then actually the additional tax that he's paying is only about 0.5%. If you hold it for 10 years, effectively it's insignificant from an overall tax perspective, given the fact that is being made out of the profit. From a fiscal point of view, definitely it makes sense. I think they have to achieve on one side fiscal glide path, which is they already given 4.5%. This year reducing by 20 basis points is also good decision that they have taken. But somewhere they have to raise money. Looks like they have chosen the buyings in the capital market to one, soothing the bringing some kind of cap on the significant rise that we have seen. At the same time, significant amount that money has been made in the market may also would have triggered them to at least bite the bullet when the going is good. So that's the way I think I see the final analysis when I do. These are the interpretation I'm making.
So I want to ask you a couple of more questions, but before that, Vikas, what is your favorite hunting ground right now, and where do you see pockets of overvaluation?
In chemical space that way, I think we still find a lot of opportunities. We're liking in some of the good interesting names in the consumer space this is where we picked up. We think IT will do well, as US seems to be showing good hope post this quarterly earnings, and IT this year could be a surprise factor. And we've been invested, and we continue to remain invested in that. So across these segments, and I think manufacturing and defense has been slightly overstressed, but you can keep finding ideas time as and when you see corrections. But generally speaking, we've been looking at our normal spaces, which some of these segments which I talked about. Banking, I think, is becoming interesting, especially some of the PSU banks have corrected a lot. We think, there's a lot of value still left, from here to look at it. So, insurance segment within the financials, both life and general, I think from here looking pretty interesting, especially 15 to 18% returns can come by. So some of these names where you find decent valuation, good growth ahead of you, are the names which we will be looking at.
How about the consumption basket, Vikas? Also, particularly autos. We haven't spoken about autos at all today in the entire conversation. How about autos? Because that is again one area where consumption demand may perk up. The market is really divided on the trajectory for autos.
We've been positive. We've been overweight on autos for quite some time since 2022, and we continue to remain positive. Especially, I think in two-wheeler space, I think CV we have kind of just moved out, but in two-wheeler and car space, we continue to remain sort of positive, and it will do well. Again, then you boil down to the company-specific thing, but generally speaking, we've been positive, and numbers have been reasonably good.
Sure. Thank you so much for joining, Vikas. Bala, we were talking about capital gains tax. So this property tax, capital gains on property also comes down to 12% now. Now, if this were to be levied, I believe that this is with retrospective effect, in the sense that if you sell your house today and you bought something about 15 years back, without the indexation benefit, the tax you would end up paying will be significantly more.
It's a math on this. See, indexation versus the indexation, you avail indexation benefit, and then you pay 20% tax on what is left out, versus the
12% flat.
12.5% that you pay.
12.5%.
Yeah, correct. So I think I didn't see much difference in terms of somebody coughing out more in the new regime. Basically, the indexation benefit, which otherwise was available for most of the assets, I think it appears to me the indexation benefit, they are completely doing away with that. And that's what looks like they have done it more for simplicity purpose. But it doesn't appear pure on the basis of the math. It actually takes away more benefit. Second is at least for the incremental buying basis, the taxation is getting reduced on the long-term capital gain tax on the real estate side. Definitely, I think it makes sense. The asset class, rather they are giving importance for the asset class, for it to become one of the asset class which can be considered by the investing community, given the fact that you get the tax benefit. Second, there was also mention about stamp duty being reasonable at the state government level, which essentially also means that in order to drive the economic growth for the next round of growth, and they are giving some kind of importance for the real estate sector for it to become the consideration of people, whether it is urban housing they have announced, then rural housing they have announced, And I think they seem to be giving importance for the sectors, given the fact you will have a many impact on the allied sectors.
In fact, my question is, will it take away from the equity markets? Will it take away anything from the equity markets? Because what you're saying is absolutely right. Because in the budget, there were, 2-3 times she also mentioned this rental. And, if you're, and we also know that, property cycle after a 10-12 year of, going nowhere, finally started to get traction. And this is again a very an important growth sector for the economy also. Even from an employment job creation perspective, it's a very important sector. So maybe this is to incentivize property and move away money from equity markets back into property markets, because at least in the last 4 or 5 years, all the new investors seem to be herding towards equity and moving away from real estate, right? So do you see a shift the other way now?
I think more than the shift, I would probably assume the real estate could become part of the consideration. Maybe the increased consideration, we could see it coming in. Of course, earlier the consideration was there mainly for the from the point of view of reinvesting your capital gain in second house up to 10 crores. You get that capital gain tax benefit, which otherwise available only for investing in NHB or other kind of instruments. Their reinvestment they were considering. I think this change in introduction of tax definitely may also make people actually to consider as equal as equity when it comes to the question of real estate assets from the ownership point of view. But anyway, from the equity point of view, as long as the growth expectation remains from the economy point of view, which is of course 8% plus kind of GDP growth, as long as the corporate earnings are able to maintain, as long as the interest rates remain somewhat low, and therefore interest rate bearing instruments is not is attractive as much as one would like to be. And in that context, I think equity will remain. I think the question would be whether investors would only consider equity. Probably that may not be the case. Real estate could also come as part of the consideration.
Fair enough. I think that's all. That's all we wanted to talk about. Thank you so much for your time this evening, Bala. And thanks for watching. It's been a hectic day. It's been a day full of news, and hope you enjoyed our coverage and benefit from it. Thank you so much.